Hey, everybody. Welcome, welcome. So excited to have you guys on. I can see several of you are already tuning in right now live. I know some of you guys are watching this recorded. Thank you for tuning in to this no BS infinite banking, how you can really supercharge your savings right now. So glad to have you guys on. Go ahead and put in the comments for those of you live. I mean, if you're watching the recording, you could do it too. But if you're live, go ahead and put in the comments, where you're from. I'd love to just kind of see where we've got. Maybe some of you guys I already know personally anyways, whether you're already current clients or you're just looking for cool strategies to do that can really not just help you make your savings work better and be safer, but also get you to make a lot more money with it. So definitely glad to have you here. Leah, glad to see you here as well. Great member of our team. Danielle, of course, having you here. All awesome to see you. So, all right. So I'm going to jump right in. My goal is really to make this as power packed and awesome as possible and really teaching this and helping you with this masterclass and really understanding how it works and really how to implement it too. I don't want to just give you a bunch of fluff and make you feel all nice, warm, and fuzzy, and then say, "Well, great, now what?" My goal is ultimately for you guys to be able to know exactly what to do with this strategy and how to make it work. And the good news is you're in the right place because nobody does it better. And yes, just so you know, we actually help you with it. Just to be upfront, we're not going to like sugarcoat it or try to be slick or anything like that. Like, no, we actually help you do and actually implement this strategy for you. So, all right, let me go ahead and share my screen. I'll see where some of you guys are from later. And I apologize. By the way, as we're doing this, feel free to, of course, put comments, questions in here. We will be taking questions at the end, so be sure be very open to doing that. We'll go back and answer some of these questions as we get to the end of this. So like I said, this is talking about no BS infinite banking. As you guys know, if you've followed me, follow my Money Ripples podcast, I'm an anti-financial advisor. I basically, because I think financial advisors suck, right? So you're going to kind of get that theme here is that we'd like to do things differently because that's what helped me be able to retire when I was 28. And this is just one of those strategies that have been able to help supercharge it. Here's the thing is that the question for you is if I can really show you how you can store your savings so that's safer than the bank or the stock market, it's tax-free, guaranteed returns and guaranteed much better than the bank. It's protected from sue-happy creditors and predators and creditors. Not to mention, it gives you this big passive income boost that actually allows your money to earn money in two places at the same time, shaving years off your financial freedom goals, just like hundreds of my clients as well as myself have done over the last several decades. Would you like to know how that works? If so, keep watching. If not, bye-bye. You don't need to keep watching. It's fine. But definitely, if you want to know how to make this work and be able to get your money working harder, this is exactly what you're at here. This is why you're here. Here's one great thing is that this is not the first time. It's not just something I've done. It's not just something our clients have done in the last few decades. This is something that's been done for decades now. If you've ever been to Disney World was actually leveraged and used. The banks were actually able to give Walt Disney money because he had this asset in his portfolio. In fact, if he didn't have it, it's very possible Disney World may not have happened. So the fact he was able to do it and get leverage from the banks is using this strategy specifically. McDonald's, when Ray Kroc bought McDonald's from the McDonald's brothers, and he was trying to keep his employees on board, he used this strategy as well. If you've ever used Pampered Chef's seed money, the start of that business was started using this strategy. We even had clients on here on our podcast from time to time. One of our clients that out in Minnesota was a dentist out there, didn't even realize how amazing it would be. But even though they were using the strategy with somebody else, someone who was kind of popular in the space, we were able to save them enough money that they were able to make an extra $2.25 million more in the next 20 years. Apples to apples, using the same cash, just doing it better. So we saved them $2.25 million of fees they would have been paying unnecessarily trying to use this strategy. Eddie Wilson, we had him on my podcast recently. He's had many, many businesses, sold them for hundreds and hundreds of millions of dollars. He actually has been using this strategy for years, and even his grandfather taught him how to use this. And I'm just telling you, the guys like the Dave Ramseys of the world, they just don't get it. Your financial advisors, most of them don't even know it's possible. Heck, even your insurance agent from State Farm probably has never even heard about how to use this strategy because not that it's unknown, but the banks and the other institutions don't want you to know about it. But I'm telling you, banks and investors have been using this strategy forever. Even Warren Buffett right now, He's as of the end of 2022, he had 125 billion of cash, but now he's got 147 billion of cash. This guy added over 20 billion dollars of cash to his portfolio in the last 6 months, all because he sees an opportunity coming that you need to be liquid. You need to have your cash ready right now. Now, just to let you know, who is this not for? This is not something that's a magic bullet for everybody. There are certain situations where this will not work for you. For example, if you're someone who's probably over the age of 70, this strategy probably won't work as much. Also, if you're paycheck to paycheck where you don't have a nickel to rub together, we probably wouldn't use this strategy specifically. We might do a different strategy to help you ease into this strategy down the road. But there is still hope for you, even if you're paycheck to paycheck and you don't have a lot of extra cash. But if you do have at least 5,000 a year, you could be saving, or you have been saving, whether it's in 401ks, your savings account for investing, or whatever it might be. If you're saving at least 5,000 a year, this is definitely a strategy you should pay attention to. Also, if you're in really bad health, this thing is health related. If you're in really bad health, this is a strategy that may not work for you. Good news, however, I had a client who actually was in that situation, had bad health, was in his mid 50s. He knew he wouldn't be able to do this strategy, but he's able to do this strategy with his wife instead, who was in great health, saved him thousands of dollars a year. And the strategy was able to work for him. So even if it doesn't work for you specifically because you're in bad health or you're over the age of 70, it could work for somebody else close to you as well, whether it be family member, business partners, or whatnot. All right, just so you know as well, at the end of this, like I said, we'll help you do this. There will be a free consult, and so we will be putting a link in there so you can get on the calendar. Parker's the one that will be able to help you out there. He's the guy, my specialist on my team that helps with this. You will get a free consult if you're definitely the person that fits in this category, which means if you can save at least $5,000 a year, we should be talking here about that. Also, for anybody who does set up this plan, this infinite banking plan, this no BS infinite banking, you also get free access to our Wealth Accelerator Academy. For those of you that know this, and you can even look it up on our website at moneyripples.com, this is something that costs like $1,000 to do. But for those that actually set up these plans, we offer it no extra charge. You become a member, really, as far as I know, as we have it right now, for life. And this is something that gives you support, help you towards your passive income goals too. So it's not just a strategy to help you save money, but it's a strategy to also help you become financially free as time goes on. And of course, I'll even show you in a little bit too about how you can become work optional faster. In fact, not just how I did it, but specifically how one of my clients who's done this strategy is actually doing it for himself, and in his 30s can become financially independent by the year 2030. So here's the challenge though that we're facing, right? We got a lot of things going on in the world that are giving us a lot of headwind. It's making us a little bit scared, and it's making you a little bit uncertain. For example, we got the government that's running up debt like crazy. We're even worried about government shutdowns, but they keep running up more debt. And so if we've been putting our money away into IRAs or 401ks and things like that, the thing is that we got the government frothing at the mouth saying, listen, if we need more money for taxes or for all the stuff that we're blowing money on, we at least got these plans and we can change the rules on you at any time and you have no say in the matter. So they know they can tap into those things and maybe even tap into those Roth IRAs that you might be trying to save. The problem is you've been putting this money away for decades only to have it ransacked and stolen from you, robbed from you. That's not what we want. We also got banks. So you think, well, I don't want to deal with the stock market as much. Well, what about banks? Well, we don't know if banks are going to go up. Banks have been failing left and right. And then they say, oh, it's just a couple banks. We're fine. Do you really believe it's just a few banks, especially as interest rates keep rising, putting more stress on banks? That's a big deal. So we've got that problem. So we don't know where to put it. Then we got other issues with inflation beating, the amount of raises people are getting. I mean, if you make over 125,000 a year, the last year, the average was only a 0.2% raise, but we had inflation that they report saying it's like 4%, but we know it's much worse than that. Come on, let's be honest. We know it's at least 5 or 10% a year, not 2 or 3 like they keep claiming it's been. Right. So we got that. And then of course we got interest rates. If it weren't hard enough, if you have any kind of debt that has variable rates like credit cards, or even people have student loans are worried about this now, we got rates going up. If you even want to buy a house, you got to pay more money for it. All of these things makes it harder to get money from the bank if you need to use it for even good things. And so that's the problem, guys, is that these are the challenges we're facing. And ultimately, at the end of the day, it affects you and your family. Because now inflation and interest rates are going up, robbing more of your money from you each and every month, giving you less and less to use. And then you think, well, okay, even if I got some cash I could be putting away, investing or whatever, well, where do I put it? How do I keep it safe? How do I make sure that if we go into another deep recession, which I know we will, if we go into a deeper recession than even 2020, what's going to happen? How do I make sure that I don't lose my money? Because the person that has cash during a recession become the king or queen of the day, right? If you have cash during those times, you are safe. You are actually protecting yourself, your family, and your peace of mind, which allows you also have money for opportunities when other people don't have it. I mean, how many of us wish we could go back to 2012, 2011, or 2012 and buy up all the real estate we possibly could? We would make millions upon millions of dollars. Even if you didn't know what you were doing, you would make a crap load of money, all because you went at the right time. Well, the right time is usually after everything tanks, and you need to make sure you have cash ready to go. But the thing is, we don't trust the banks because we don't even know if the banks can do it. By the way, FDIC only keeps about 1.5% of reserves on hand. What does that mean? That means if, let's say, 10% of banks fail, they can't even pay you the money that they say they protect with, the 250,000. They can't even protect that money. So how do you know it's going to be safe? I'm going to teach you how to not even rely on the banks, get away from the banks more and be able to make this work. And that's using this max ROI infinite banking. Or in other words, the vehicle you're using is this high cash whole life insurance plan, right? Yes, it's whole life insurance. It's the most boring, unsexy thing in the world. But if you do it right, you can actually make it quite sexy. And I don't mean like, I don't mean physically sexy. I mean, like, it actually can be a lot better than just a boring, stable, secure, tax-free savings account. So I'm going to talk about that. Now, this is not the traditional old, if you guys have heard of infinite banking before, then not the old Grandpa Nelson Nash type of thing where they say, put it away for many, many, many years, and then you'll have this retirement someday. This is something that, although you could do that, this is something that can actually benefit your life now. It can actually help you become not just financially stable, but actually have cash available that you could be using to invest today. Now, I'll give you kind of a background on me here a little bit more because I used to be a financial advisor. I quit that after I realized that financial advising doesn't work. Became a real, got more into real estate. And while I was doing that, I started hearing all these real estate investors talk about this infinite banking strategy, becoming your own banker, like Grandpa Nash taught us, right? Again, great guy, great concepts. And I read the book and I remember thinking, how did I never hear about this? Because I was a financial advisor for 4 years. Not once I ever heard the term infinite banking. But these guys in real estate investing, they loved it. So I remember I went to a guy, I set up a policy, even though I was insurance licensed myself and I have been for the last 21 years, I set up this policy. I said, cool, looks great. Can I do this better? And the guy said, no, this is how it's designed. This is how it's set up. And I just took his word for it because I always taught people that whole life insurance was crappy. Never do it. You're better in the stock market. Later realizing that the stock market sucks and it's just high risk and low returns. So I ended up trying the strategy out because, hey, he told me it was great. All these real estate investors told me it was great. I did it. Well, 2 years later, the recession hits. We had the Great Recession, right? I was paying to this thing about $10,000 a year. Up to this point, I'd already put in like $25,000. Well, as my finances became more restricted, right? Like as the real estate markets were falling, the new business I started was tanking. So we were even taking home paychecks. I didn't have the cash to keep paying these expensive premiums that I set up. And I called the insurance company. I said, what can I do? And they said, nothing. You have a couple $100s of cash in here. You have to make payments or it's gone. And so I lost it. 2008, I lost my policies. I said, oh, well, I guess it just happens. I'll get another one later. Well, about 6 months goes by. I'm talking with somebody. And I realized I could have done this better. I could have actually done this to where I didn't have to lose all that money because I was kind of bitter. I mean, $25,000 to pay into a plan to then have it cancel on you is like the most expensive, crappy term policy you could ever have. And so I remember I confronted the agent because I said, hey, listen, I'm insurance licensed too. I found out we could actually do this better. You lied to me. And he's like, no, I didn't lie. You need the death benefit, yada, yada. Right. Oh, so, right. So we had this 2-hour debate back and forth. I'm running numbers. He's showing me numbers. And at the end of the day, as I get through all of his excuses, I even beat his numbers. At the end of the day, he just said, Chris, the reason I sold it to you the way I did, which means you had no cash in the beginning, is because I couldn't afford to cut my commissions. And I said, there is a reason why I'm never going to send you a referral again. And I didn't. I had sent him dozens of clients to him that sold him the same crappy plan, this really the traditional infinite banking plan, the one that Dave Ramsey and Susie Orman will rip on. And I do too. because it was expensive up front, lost all this cash that really I had nothing in there. I found out you could have cash in these things from day one. In fact, the majority of your cash from day one you can have in there. And it actually builds and grows. And in fact, it becomes free insurance after like 5 or 6 years, right? It becomes something that you ultimately ends up being cheaper than term policies as you time goes on. That's the reason why I'm doing this, right? That's why I'm screaming this from the rooftops, because as the years have gone on since, the mid 2000s, now going to the 2020s, we have perfected a system to give you the max ROI possible, meaning lowest cost, the best return on your cash, so that this does become not just an expensive life insurance policy, but instead it becomes like a tax-free supercharged savings account. So that's why we talk about no BS infinite banking. By the way, we don't even withhold numbers from you. We actually show you the numbers right then and there. If you do a Zoom call with us, we show you the numbers. None of this hold it back. Like, hey, we're going to show you the numbers, but we're never going to give you the numbers because we don't want you shopping us. We don't care because we know we're going to beat everybody out there. We are going to have the lowest cost, highest return possible legitimately that nobody else can compete with. Less than 1% of the time, we run a situation where somebody matches our numbers because they know how to do it. But most of the time, insurance agents won't do it because same reason that my insurance agent didn't do it either. They set it up because they make a career out of making commissions off of you. Even the guys that say they're investors out there, they'll charge you double than what you should be paying. And we don't want to BS you around. We want to make sure you get the best every single time, not just whenever they feel like it or they feel like they're competing with somebody else, then they'll give you a better deal. They should give you the best deal right up front. You shouldn't have to question their integrity every time. That is our promise, that our integrity doesn't ever come into question. We give you the best every time. All right. So here's how it works. Okay. So like I said, this is an insurance policy. One thing is tax-free. This is a lot like a Roth IRA, but without all the stupid rules. So it's tax-free. You put the money with after-tax dollars. It grows tax-free, comes out tax-free. And when you do happen to pass on as well, it also goes to your family tax-free. So really, it's like a potentially tax never situation when you're using these after-tax dollars. But the great thing is, unlike Roth IRAs, it is 100% in most states, 100% protected from lawsuits and creditors. That means even if somebody sues you and wins and you have millions of dollars sitting here, they can't touch it. Just like Hammer said, you can't touch this, right? You can't touch that money. They can't get to it. Also, it's safer than the bank. You can store millions in here safely. So remember I mentioned the banks, they're supposed to have that $250,000 protected for you. But what if those banks start failing, which I think there will be more failures than what they're talking about right now. If there's more failures, what do? If they don't have the money, they're going to say, well, just give us some time and you'll get your money back. What if you need the money right then? Well, insurance companies don't gamble like the banks do. Banks actually do invest in things. That's why we heard about, Lehman Brothers and Bear Stearns failing during the last recession, right? This is why we hear about banks failing, like during the Great Depression. There were 35,000 banks before the Great Depression. Afterwards, 13,000. But guess how many life insurance companies failed? 4. Just 4. Not 20,000, but 4. And on top of that, even though if they do happen to fail, they also have to buy legally insurance on themselves. So there's other insurance companies that will insure them in case they ever go under, making your money protected 100%. This is the place. This is if you're going to store a lot of money and keep it safe while getting better returns than the bank, this is the place. Like I mentioned, guaranteed growth. Usually it's at least 3% guarantee, no matter what. But even in the lowest interest rate environment, they've been paying like between 5 and 6%. And it's now because of interest rates going up. That's good for you because interest rates drive up this as well, meaning you get paid higher returns tax-free, which kicks the crap out of any savings account or CD you can possibly get. There's no stupid limits or penalties. You don't have like this 59 and a half age rule. You have to wait till, or you get slapped with 10% penalties. Nothing like that. There's not even limits saying you can only put in $6,000 a year, right? We have people that are putting in $500,000 plus a year into these kind of plans. You can put in 25% of your stated annual income that you're making. So lots of more flexibility. Definitely tax laws do change. You know how with IRAs and 401ks, if laws change, you have to go with it. Here, it's a contract. Whatever the tax laws are today, you get that benefit forever. So even if the government decides that we want to tax life insurance, it does not affect you as long as you buy it while it's still tax-free. By the way, they've been trying to propose that for over 100 years, and they've yet to do it successfully because insurance companies are pretty big. They like to lobby. So they like to stay tax-free. And of course, the politicians who put their money in here also like to keep their money tax-free, which is why you don't see it ever get taxed, right? Bank leverage. That's another thing I'll talk about in a bit. Protects your family, of course, in case of your death. That's one great thing. A great thing I love to tell people is this is ability for you to be able to spend down all your inheritance, but still pass it on, right? You can actually spend down your money while you're alive, yet still pass on something to your kids and create a legacy, even if you want to create it for generations beyond. And most importantly, you have access to cash now. Like I said, this is like an actual savings account you can get to today. It doesn't have to be something that's locked up till you're 59 and a half. You can actually have access to it right now. So let's dig into really how this works and how we use this. Number one, emergency fund. I've kind of mentioned this already, but I don't trust banks. Now, I will keep money in the bank for that money I need tonight, right? Or today, or money that I might need in the next few days. But I know I can get to my life insurance cash. Usually by the time it transfers to my bank account, I can get to it usually within about a week. So if that's the case, I'm going to keep a small portion of money in the bank while I keep the rest, my lion's share, in here. So for example, my wife wants me to keep $300,000 liquid. She says, I don't want you to touch any money. This is not money to invest. This is money just to protect our family in case the worst were to ever happen. But I told her, I said, honey, listen, I don't want to keep this money earning 0.1% of my credit union. That's ridiculous. 0.1% on 300,000 is only $300 a year. And then they tax me on that $300 a year. So I really walk away with like $200 in a year from 300 grand. That's a huge opportunity cost, especially when there's inflation. And so I told her, I said, let's do this. Let's keep $250,000 in this life insurance account where I'm making over 5% tax free. And then the other 50,000 we keep in the bank. So then you can get access to it quickly if you need to. And that's how we've done it. So here's the cool thing. 5% tax free on 250,000, right? Is 12,500 tax free. Plus I still make $50 a year taxable in my bank account. I still make well over $12,000 more than I would just keep it in the bank. You understand? Like that's huge. Really, even if you're looking to buy a rental property, you can save that up for 2 years and have a down payment for a rental property and be cash flowing on that too, just by getting your money to work harder and safer at the same time. Cash flowing investments. I'll talk about that in a little bit, but you can actually get your money to pay you twice, not once, but twice on this money. Collateral. Let me give you a story of one of my clients who had a policy and he said, Chris, I want to buy a building for my practice. He was a chiropractor. He says, I want to buy a building for my practice. I've got 300,000 of cash sitting in my life insurance. I think I'm just going to cancel it, cash it all out, and then use that money. And I said, don't you dare cancel it because one, you get taxed if you try to cancel these plans. So don't cancel it. Instead, let's go to your bank and see if they'll give you a mortgage using that as collateral on top, as well as using the building that you're buying. So it's double collateral for the bank, which they love. And guess what? The bank loved the idea. They even gave him a rate that was 2% less than the rate at the time. He had this dirt cheap mortgage payment that he was able to get, just amazing terms, paid almost nothing in interest on this building. And then after a year and a half, he had it built out. He even got extra money, by the way, above and beyond what was in the cash in his policy. So he got $375,000, even though he only had $300,000 in the policy. And then guess what happened next? Year and a half later, he goes back to them. He says, listen, I'm done. I've renovated the place. I have a renter in here now that's paying my mortgage for me. I want to, can I take the lien off my life insurance? And they said, yes, absolutely. We'll use the building as collateral now. And they kept the same dirt cheap interest rate that he would never have gotten had he just used the building in the first place. So he was able to leverage this and get better terms and able to now positive cash flow on a building that he's essentially working in rent free. That's the power you can use with this. Pay off loans. You can use the payoff, especially high interest loans, credit cards. I've had people do that as well. Here's the great thing. Even if you borrow from this policy to then use it to pay off a loan, the difference is that when you borrow from this policy, get a line of credit against it, it doesn't show up on your credit report, which means there is no such thing as late payments. You can pay it back however, whenever you want. The deadline for it is your death. That's and I'll talk about how that applies here later too. Yes, it can be extra retirement income. Of course, it's something you can use. The great thing is you don't have to wait till you're 59 and a half. You want to retire at 50? Great. You can retire at 50 and pull this money out tax-free, just like you would with the Roth. But again, none of these dumb 59 and a half rules. So you can do that. And of course, kids savings. I have so many people lately saying, my college savings plan, that 529 plan sucks. I hate it. I hate the fact that it's in the market and that I can lose money right before my kid goes to college. If the market happens to go down, then I've lost potentially 1 year of tuition because that happened. So instead, they're putting it over here because they know it's safe. And even better yet, because they know they can also invest with it, like buy real estate and things like that with this money. They can do it for whatever they want with it. Great thing is now they can go and make extra money on that, and they don't have all the rules. So if their kid doesn't go to college or the kid gets a full ride scholarship, great, we use the money for something else. And you control the money, it's all yours. So that's just some of the ways you can use it. I know I'm kind of breezing over this, and we can always, if you have questions on this, put it in the chats here for more questions so I can clarify on any of these strategies here. Let me talk about the one about cash flowing investments. How do you get your money to pay you twice, right? We call this double arbitrage. If you have never heard the term arbitrage, here's what it is simply. Walk into your bank, look up at their little screens where they have the boards up there, and you'll see one end of that screen says, look, I will pay you for a 5-year CD at 3% a year. And then on the other board, you'll see a 5-year car loan at 7% a year. You'll say, hey, look at that. The bank borrows my money by taking it from the CD that they only pay me 3% on, and then use it to make 7% on that car loan when I borrow money from them. And you might think, oh, well, that's only 4%. Because if that were a $10,000 car loan, that means the interest for that year, actually not, yeah, $300 of interest for that year. But then you pay them $700 of interest for that year. So that $300 became $700. They made more than 100% rate of return on their money. They made multiple returns there. That's what arbitrage is that you can borrow money and then turn around and use it to make a higher return than what it cost you. But in this case, it's not just borrowing like you would taking a mortgage from your house and using that to invest. And that is arbitrage if you can make higher returns. This is double arbitrage. You actually get money paid twice. So here's how. So normally people just put their money right there in their savings account. They put in the investment. The cash flow from that investment, the money, the income that's coming in from that investment goes to pay back into your savings account. So you might have drained your savings account doing that investment, but then you use that cash flow, that income to help replenish it to build it up again. All in the meanwhile, you're earning 0.0% on that money, and really you have no savings anyways. You have to slowly build that up over time. But it's different here. When we use the life insurance, we can do the same thing. We could withdraw the money, but when you withdraw the money, you now have what's called a lost opportunity cost, meaning that now your money is no longer earning interest. It has to go in and get invested somewhere to earn interest. And even then, if you borrow the money and then go to do that, say you borrow at 5%, but then you make 10%, you make that extra 5%, right? You make double the money, but that's it. Because you're not really making money in the savings account when you're starting to pay that money back in. Well, here, if instead we use the life insurance, yes, we can get that line of credit from the life insurance, but the interest, if you use the cash flow from that investment, the income that's coming from the investment, if you use that to pay down your line of credit, you will pay less interest than what they're paying you. Because here's the thing, say you have $100,000 inside of a life insurance policy, you want to borrow $50,000 from them, you don't pull it out of your 100,000. Your 100,000 is still there. You just get a line of credit from the insurance company who acts like the bank. And then they give you the money. They charge you interest, yes, but it's very low interest, much lower than what you'll get from a bank today. You get that interest there, but then guess what? Now you can use that money to invest. So you take that 50,000, say you invest, you make some money there. Well, that money comes in, pays down the line of credit. You pay less in interest than what they're paying you on that 100,000 already, and you're still making money on the investment. You actually make money twice. So let me show you an example here with the 30,000 loan. So say that right now you have your cash value policy. You get a loan from them, again, from the insurance company, you get a loan and you get $30,000. You get that investment and say that 30,000 pays you $3,000 a year, 10%. Well, you're going to take that 3,000 a year of cash flow and you're going to use that to go and pay down that line of credit. So that $30,000 loan that you got, you're going to take that 3,000, pay it down, and you got it down to 27,000. Well, now you're only paying that small interest on the 27,000, right? And then you just keep doing it again, keep cycling that money through. Yes, they'll charge you interest, but what will happen is that your money, that 30,000 that you had in the policy, keeps compounding and growing tax-free. So it goes up while the interest you're paying on the loan goes down. So even if you didn't invest it, I mean, obviously you are investing, right? But even if you were just making the payments, you're still going to win out because you're compounding interest faster than what it's being used on that loan. So let me just give you an example of what that looks like, right? So say that you buy, when I say small apartment, I know it's not small money, but I'm saying a small apartment, like small number of units, not a massive thing. But let's just say that it's $1 million apartment complex. You put $250,000 down. Your cash flow, say, is $2,500 a month after you pay all your expenses. So same thing. You're going to take that 250,000, right? If you pull that out of savings and then you go and invest it, well, that 2,500 a month is going to slowly build up your savings over time. In fact, over 9 years, you'll finally put in 270,000 bucks, right? But instead, what would happen if we compare that to using the life insurance, doing that same exact thing, but just getting a line of credit from the insurance? So here's the example here. If you use your savings, guess what? After 9 years, you made a whopping 1,200 bucks in interest after taxes. That's it. 1,200 bucks. That's all you made. That's all you make in 9 years on your freaking savings account, making point nothing percent. But if you did the same thing with insurance, watch this. 126, almost 127,000 a year that you made extra net. Even after you've paid the interest to the insurance company that they've charged you, you still make about 126,000 more. Guys, that's 100 times more the return in just 9 years. What could you be doing with an extra 126,000? Could that be another, small apartment you could be buying with that can also cash flow more money? Could that be money that actually helps set your family free, right? It's just giving you extra cash in general than just using the bank, which again, banks are fine. It's not like they're horrible, but we don't know what's going on with the health of the bank. We don't even know if our banks that we're using is going to be around tomorrow, because there's definitely something coming down the road that is uncertain. I want to keep my money in a place where I know it can make more than the bank, it's tax-free, and it's better protected from lawsuits and creditors. By the way, did you know if you got sued that anybody can tap into your savings account? They can even get into your IRAs. Yes, they can. The only thing they really have a hard time getting to is your 401k or this life insurance. And 401ks suck. So just to give you an example of this guy doesn't want to use a 401k because he's right now in his early 30s. He actually sent this to me. He said, Chris, here's my plan right now. He's been buying rentals for the last couple of years, and he's only putting about 15,000 a year away into his life insurance plan. But he's been using some of that money to help buy other properties. And he's taken also the cash flow from his properties to use that to buy more. So his plan is basically buying a cash flowing property a year, right? Small property, nothing big. But as he's doing this, his cash flow keeps increasing. For him to do it by 2030, he says, Chris, I had to bridge the gap, because you'll see at the top here, his investments by 2030 was $4,250 a month is what he gets it up to. But because his life insurance, because he can access that money whenever he wants, he says, Chris, I'm actually going to access that money, 950 bucks a month tax free. I said, well, that's almost 12,000 a year. I went and I ran the numbers. I thought maybe he was being a little bit, optimistic. He was exactly dead on. I ran the numbers and he could pull that out for life. Even if he's in his 30s, he'd be pulling out 950 bucks a month from his insurance policy while also cash flowing his real estate investments. He's actually doing it in two different places at once, allowing him to be able to retire when he's still in his mid 30s versus waiting till he's 60,000 years old, like the traditional financial advisors tell you to do, right? So I've even had other real estate investors who've done this. Like I had one guy, I asked him, I said, hey, why do you do it? Because he's a big time real estate investor. He said several reasons, but one, I asked at a mastermind that we're a part of. He says, where do you guys safely keep large amounts of money? He said, no one had a great answer to that. I will say there was one person that had a great answer to that, because I was the one that raised my hand and said, Ron, you already know the answer to this. You have one of these plans already. Maybe we should get another one. And so he did. But he says, basically, a bank was what everybody said. Even these guys that makes millions of dollars a year in real estate, all they could think of were banks. And he was realizing that his bank was basically, for lack of a better word, screwing him over. They actually said, hey, I don't care if you have millions of dollars with us. You're not big enough fish for us to care about. And so as a result, he says, well, great. I don't need to keep my money there then, do I? And so he did that. He also mentions too, very few insurance companies have ever gone under over the years because they're regulated differently than banks, right? Therefore, the money is safer. The rate of return on the savings is typically higher. And he says that the loan cost is also lower than traditional financing, which is true. Like he says, it's not attached in most states for lawsuits. And from a simple insurance standpoint, he's like, you own it and they can't take it away if you get cancer, right? So even that's the thing, it's a whole life insurance policy. So it's not like term where it gets more expensive over time, or eventually you cancel it right at the point where you're about to die and then you have nothing to leave your family. This actually protects you. And especially if you're trying to build a bigger estate, just so you know, one of the ways that the government talks about all the time of getting more tax money is taxing, quote unquote, the rich. Well, who do they define as being rich? Could it be somebody that only has a few $1 million maybe? I mean, right now it's like 12 million on up. They consider rich and they'll tax the crap out of you. But Hey, what happens down the road? They say, you know what? There's just too many people getting away with taxes. We need to nip this in the bud. And what do? They go and they tax you too, right? Obviously, Neil, he talked about he didn't want exposure to banks, and credit protection as well as something that was big for him too. So, guys, this is how you make money twice, right? This is how you're able to get your money to work for you in two places at once. You can make a net positive return just with by borrowing the money from the insurance company, making a higher return that they pay you on the money versus what you pay them. And then you also can invest it too. All the meanwhile, your money is protected. And here's what it really comes down to, guys, is that really the most dangerous risk of all is the risk of spending your life not doing what you want on the bet that you can buy yourself the freedom to do it later. How many times have you been told, set it and forget it? Wait for someday, and you know what? And eventually down the road in 10, 15, 20, 30, 40 years, when you're debt free and you can retire, then you can live the life. How do we even know that we're even going to be around then? Guys, I never wish this on anybody, but out of hundreds of our clients, I've had a few people that have passed away in their 20s, even their 30s. And I'll tell you, like, their family misses them badly. And to have not just something that allows you to have this death benefit, right? That of course protects your family. Most importantly, it allows you to get your money working for you right now. It's not about set it and forget it. Hopefully someday it'll be there, even though people are becoming disappointed, realizing it's just not enough. You don't have to be that casualty. You can have a different life. Yeah, I think about this. I took the screenshot off my phone when I was driving one day. It was so good, I had to get it. But you can see that it's supposed to be 1 minute, but you can see the other alternative route is going to take about 25,000 days longer to get to my destination. Funny enough, I was actually driving to my bank. Um, this is the thing, guys, is that we can try to take the common path everybody tells us to take, but there's a shortcut to get there. You can do it better and faster. And the way to do that is by getting that max ROI. That's what we always focus on, is getting the best bang for your buck so that you have hope to not have a someday, but that you can actually let someday be today, to live your life now, not tomorrow. That's ultimately what I want to do. So, as I said, you guys want to be able to know how to set this up, especially if you're already saving money as it is, and especially if you're investing money. This is something you should be looking at parking your money into so that it can be used to invest better. Um, that's what we'll offer you as a free consult there. Like I said, anybody who actually sets these plans up with an infinite banking plan will also get free access to Wealth Accelerator Academy, where you have group coaching calls with myself. You can ask me questions, as well as Craig, who's our head coach on the consulting side for passive income type investments. We talk about those things too, to give you that full, well-rounded approach, giving you fast results today. So, all right. So that's where we are right now. Let's see what questions you guys have for us. Go ahead and type them in the chats, because it does take some time to get there. Kenneth, by the way, good to see you. Peter from Massachusetts, great to see you as well. Let's see, who else? Oh my goodness, we got all kinds of people. Liz, good to see you're on here too. Let's see. Okay, I have not seen any questions yet, unless I just missed them. MoneyRipples.com is our website. Okay, great. I'll open it up. Any other questions for me at this point? Like I said, the reminder is go set up a meeting. You can set that up with Parker. That link that she's putting in the notes right there, link to run numbers with your team. There's a bit.ly link right there. That's in the side column. If you're on YouTube, if you're on Facebook, LinkedIn, whatever, it's right there. You can see it on YouTube as well. Click on that. If you're watching the recording, you can also click on that too, and you can set up a call. And like I said, this isn't for everybody, but like we said, we don't BS you around. If it's not a good fit, we'll tell you. In fact, just last week, we were talking to Parker, and he actually mentioned, he said, they were kind of in a rush. I noticed that they're in this transition of life. They wanted this plan, and I told them no. I said, nope, don't do it. So, here's a question. So, anyways, we want to make sure it's the right fit for you. Same thing. If you currently have a plan, if you already have one of these infinite banking plans, you're not sure if it's good. Remember that couple that we saved $2.25 million? I actually wasn't going to touch it. We weren't going to do anything with it. They just asked us to look at it, run the numbers apple to apple, see if it was worthwhile. Found out it really was more than I expected. That's why I said in just 20 years, it was $2.25 million better with our plan versus the one they'd already set up years prior. Al asked, why not use Index Universal Life? Oh, Al, I'm so glad you asked that, because I was going to include that slide, but I always like to be like quick and to the point, right? Why not? Because Index Universal Life doesn't work the same. Just so you know, I actually used to be a fan of it before I learned about how you could do this with whole life. I actually used to sell index universal life as a financial advisor. The problem with it is this: one, you don't know the stock market will go up each year. If it makes 0% or whatever the floor is, the problem is you can actually lose money in that plan. Where whole life, you're guaranteed always to make money. Universal life, you can actually lose money. They also have very expensive surrender fees. So they have surrender charges up front that makes it harder for you to access that cash up front. They, on purpose, make you wait to touch that money. Even if they set it up decently, right? It will still make it worse. But here's the ultimate reason why I don't like it. Because there are a few of them that do give you that double dip effect, but that's a very, very small percentage of those that allow you to do that. The big reason is this, is that the insurance costs in an index universal life go up each and every year. It's term insurance that renews every year. And of course, the older you get, the more expensive your insurance. The costs go up every year. So imagine this, if the costs go up every year and at the same time the market goes down, even if it has a floor of like 0 or 1%, those costs going up will eventually eat your cash. And almost every time I see somebody with these kind of plans, even the ones that I used to set up, the problem is by the time you hit your 60s or even 70s, they run out of cash. That doesn't happen with whole life. So the problem is everybody tells you to buy these things and then they can become retirement income for you. But the problem is if you start pulling out retirement income and you happen to have bad market timing, it actually just wipes that cash away fast, especially with those increasing insurance costs. So it's unpredictable. There's too many variables. It gets more expensive than how we set up these whole life plans. We actually set them up just as flexible, if not better than IUL, and they usually have more cash from day one. So we make it better, right? And there's not all the risks and the non-guarantees. So that's a big reason too. James asks, are the policies set up like a term policy, like 500,000 or a million? Good question. So yes, you can set them up that way, James. You can set them up based on the death benefit, but that's not what we do. We actually we reverse engineer it. We figure out how much money do you want to put in max per year. Notice I said max per year. Even when I said $5,000, that could be your max. Your minimum on that 5,000 that you're actually required to pay in might only be about 1,000 or so a year. So there's a range. Whatever the max is, and like say you set the max at 25,000 a year. That's kind of the average of what most of our people put in. It's 25,000 a year. The minimum is usually about 5,000 or 6,000 a year, and that's it. If you're younger and healthier, you might even have it cheaper than that. And so we reverse engineer it, and we instead say, well, for 25,000 a year, what's the minimum death benefit needed to still keep this tax free without breaking it? You know how I mentioned that, just as a side note there, you know how I mentioned that there's people that may be lucky if they match our numbers, and that's true. They'll only match it. Occasionally, I've had somebody, very rarely, say, hey, somebody sent me this illustration from this other insurance agent, and I think it beats your numbers. But I looked at the numbers, and you know what they had to do? They had to break it. They had to make it a taxable account by trying to reduce the costs to only just barely beat ours. And so I said, nope, they cheated. They basically just try to create a crappy taxable account for you that's not protected from lawsuits and creditors. You lose those protections. They just did that. You don't want that kind of policy. They would have screwed you over. So that's one big reason why. So James, to answer your question again, we really do set these up. Yes, they can have a death benefit. We could aim for that, and we do a lot of times because there's cost breaks at certain death benefit points, like 500,000, for example. But we usually just reverse engineer based on how much you're wanting to put in, what's the max you want to be able to contribute, but be able to do a minimum too. Here's another key point. Here's something to remember that we tell all of our clients. With these plans, you can always pay less, but you can never pay more. Again, you can always pay less, but you can never pay more. If you set that max at 25,000, that is the max you could put in per year. You cannot put in a dime more, otherwise it will trigger taxes, and we don't want that. We like tax-free. We like protected money, right? So instead, if that were the case, somebody has more cash, which we've had happen many times because people start investing or they get raises at jobs and things like that. Great, we just set up another plan. So you can have multiple policies on yourself more than once. Peter says, I heard Mass Mutual was one of the better companies. What companies do you use in the plan? You're absolutely right, Peter. Mass Mutual is one of the better companies. They're not usually the best. If you're in New York, New York's a special little state there. We will use Mass Mutual for New York, especially because there's very few companies that can do business in New York State. But we use companies more like Penn Mutual. Mass Mutual, I tell you, man, they have been clawing and fighting for our business. Main reason is because we would be one of the top producers for Mass Mutual, and so they They try to wine and dine you and all that kind of stuff. They do the nicer trips. I'll tell you that much. There's a reason why you'll pay a little bit more on the insurance cost with Mass. Again, Mass is a great company, and they're a close second place. But Penn Mutual usually comes in first for us because we can reduce the cost more. And even when Mass sometimes might have like a 1/4% more dividend, Penn Mutual, because the costs are so much less, will beat it regardless. So here's the thing is that it's not always about the dividend. It's actually about what the cost, what you're able to do with the cost, how flexible is that company willing to lower your cost for you. That is the key secret that we do. And we get insurance agents ask us all the time. I know there's some insurance agents watching this right now. That's the thing is that we just figure out like how do we get the cost as low as possible while still keeping it tax free and from not becoming a taxable account. That's what our secret is. And we've just played with the numbers for years and years and years to perfect this to an art. So great questions. I'm glad you guys brought these up because these were slides I thought about putting in and I didn't, but you asked exactly those things that we should have. All right. Any other questions before I let you guys go? All right. Well, I know it takes some time and there'll probably be questions later. We can always answer online for you too. So those of you guys tuned in here live, thank you so much. Again, you can use the link. You can get on Parker's calendar and you'll get first priority. Those who watch the recording, you can still use the link and it should still work unless it's years from now. Then I can't promise anything. But anyways, guys, definitely reach out for the free consult. And like I said, if you get that infinite banking policy set up with us, we also, as a bonus, give you the Wealth Accelerator Academy membership for free, saving you $1,000 a year right there alone. And the education on that, man, even with the cash flow secrets I give, our average client finds about 34,000 a year from that kind of stuff. So it's a great way to help improve your cash flow and also get the best infinite banking policy you can possibly get on the market. And I'll just tell you this: somebody asked me this the other day. They said, "Hey, Chris, like I heard somebody that told me you're the best in the industry." And it's like, yeah, we are. We are the best. This is one of the two things we do best. This is the best we're here, and we're definitely best in helping you create passive income to go with it so that you get to your goals faster instead of taking 25,000 days to get to that same destination. So anyways, guys, make it a great day. We'll see you later.